Picture this. You find a company that's forecasting a revenues leap from around 48 million to 180 million in a single year. That's a mind-boggling 350% jump. What's your first reaction? Is this the investment of a lifetime, or is this a massive trap waiting to snap shut on anyone who buys? Today, we're looking at the company at the center of this very scenario, Ondas, trading under the ticker ONDS. But this isn't just about numbers on a page. It's a story about autonomous drones, combat-tested robots, mission-critical communications for North American railroads, and a series of hype-aggressive acquisitions that have utterly transformed the company. We're going to break down whether this explosive growth is the real deal or just unsustainable hype. So, is Ondas a rocket ship on the launch pad or a house of cards in the hurricane? Let's find out. To really get Ondas, you have to understand it's not just one company, but two completely different businesses sharing the same roof. The split is key to the whole story. First, there's Ondas Networks. Think of this as the slow and steady foundational side of the business. It provides private wireless networks and software for mission-critical industries like railroad, utilities, and government agencies. This is the unglamorous but absolutely essential infrastructure, the plumbing that makes everything else work. It's a business built on stability, long-term contracts, and embedding itself deep into major industries. And then you have the second phase, Ondas Autonomous Systems, or OAS. This is the high-octane, high-growth engine that's cranking out the jaw-dropping 350% growth forecasts. This division is all about the future. AI-powered defense platforms, autonomous drones, ground robots, and sophisticated counter-drone systems. It has been pieced together through a rapid-fire buying spree, gobbling up cutting-edge tech from companies like American Robots, AI Robotics, Roboteam, and Centric. So you got a tale of two companies. One is a stable, long-haul industrial play, and the other is a fast-moving technology aggregator in a red-hot autonomy and defense space. The tension between the two is exactly what makes Ondas so compelling, and also pretty complicated. Let's start with the bedrock, Ondas Networks. It might not be the source of the explosive growth, but its role is critical for the company's long-term health. Their key technology is a platform called FullMax, which is built on a wireless standard known as IEEE 802.16t, or .16 for short. Now, getting an entire industry to adopt your tech standard is like finding the Holy Grail. It's brutally difficult, but if you pull it off, you build a massive competitive advantage. And that's exactly what Ondas seems to have done. In April of 2025, the Association of American Railroad officially selected .16 as the new standard for its next generation train communication system. This decision is set to kick off a multi-year upgrade cycle across all of North America's freight rail infrastructure. We're talking about an estimated 70,000 systems, including over 25,000 locomotives and 45,000 end-of-train devices that will need to be modernized. This single decision unlocks a massive multi-billion-dollar market for Ondas Networks. But this is the long game. Revenues from this division have traditionally been lumpy, at the mercy of slow spending cycles of giant railroad companies. With the AAR standard now locked in, the company has a much clearer path to stable revenues for years to come. This division, a solid, reliable base that gives the entire business credibility. All right, so on to the main event, Ondas Autonomous Systems, the division lighting the fuse of those headline-grabbing numbers. In January 2026, Ondas dropped its preliminary results for 2025. Full-year revenues is expected to hit between 47.6 and 49.6 million, smashing their previous target by 23%. The fourth quarter was a monster beat on its own, coming in at 51% higher than expected. But the number that made everyone sit up was on the guidance for 2026, a cool 170 to 180 million. That's more than a 3.5x jump from 2025. So how could that even be possible? The short answer is acquisitions, paid for with a massive war chest of cash. Ondas has been on a strategic buying spree, assembling a portfolio of companies that creates a comprehensive system of systems from autonomy to defense. They bought American Robotics and AI Robotics, giving them the approved drone-in-a-box solutions, which are fully automated drones for security and data collection. They snapped up Roboteam, an Israeli firm whose combat-proven ground robots are already used by the militaries in over 30 countries for missions like bomb disposal and intelligence. And they purchased Centric, another Israeli tech company with patented counter-drone tech, that can actually take control of hostile drones. This isn't just a random shopping cart of tech, it's a curated ecosystem. They can now offer integrated air and ground robotic platforms under a single command. This strategy puts them right in the sweet spot of today's biggest trends: soaring global defense budgets, the need for autonomous security, and the urgent demand for effective counter-drone systems. The OES division is the rocket fuel, plain and simple. We're about to dive into the biggest risks facing Ondas, including the one detail that could make the whole story a trap. If you're getting value out of this deep dive, do me a favor and hit that like button. It really helps the channel by showing the algorithm you appreciate detailed analysis. And to make sure you don't miss the next breakdown, hit subscribe and ring that notification bell. A 350% growth target and a string of acquisitions all lead to one big question: where did all this money come from? The answer is a capital raise of stunning proportions. Recently, Ondas closed an offering that brought in around $959 million, which, when combined with other raises, left it with a pro forma cash balance of more than $1.5 billion. On the surface, this is amazing news. It completely de-risks the company's balance sheet and gives them even more than enough firepower to integrate these new companies and fund growth. But this is where the trap is hidden. Raising that kind of money comes at a cost, and that cost is dilution. To raise nearly $1 billion, Ondas had to issue a massive number of new shares and warrants. One offering alone involved 19 million shares of common stock, pre-funded warrants for another 42 million shares, and common stock warrants to purchase another 121 million shares in the future. For existing shareholders, this is a huge risk. Every new share waters down their ownership. The company's growth now has to outrun these dilutions just for investors to see gains on a per-share basis. That's the trap. If that projected growth stumbles, the weight of all those new shares could crash the stock price. And dilution isn't the only risk. There's immense execution risk. Successfully merging multiple tech companies, each with its own culture and platform, is a monumental challenge. Any stumbles could lead to delays and kill momentum. Finally, the OAS growth story hangs on landing large government and defense contracts, which can be unpredictable. While the company's backlog has surged 180% to over $65 million, that's still just a fraction of their $180 million revenue target, meaning they have a lot of deals left over to close. So after all that, we're back where we started. Is Ondas a generational opportunity or a carefully laid trap? The honest answer is it's both. It just depends on your appetite for risk. Now here's the bull case. Ondas has transformed itself from a small-time player into a credible technology provider for the industrial and defense sectors. It has a stable foundational business in Ondas Networks that is poised for steady growth thanks to AAR's adoption of its .16 standard. On top of that, you have an exploding growth engine of OAS, perfectly positioning to ride the massive tailwinds of defense spending, and a $1.5 billion cash cushion provides a powerful safety net to make it all happen. But now for the bear case. The company's valuation has skyrocketed, and it's now priced for perfection. The massive shareholder dilution means the bar for success is incredibly high. If management fumbles the integration of its acquisitions, or if those big ticket contracts don't roll in as fast as projected, the stock could face a painful correction. Ultimately, this is not a stock for the faint of heart. The stock has pivoted from pure speculation to a bet on management's ability to execute an incredibly ambitious strategy. The growth opportunity is real, but so are the risks. So is Ondas a buy? The consensus from the research suggests a more cautious approach. It's a firm add to the watch list for me. For investors with a high tolerance to risk, it presents a compelling speculative growth story. The combination of the $180 million revenue guide, the massive cash position, and the powerful catalysts in both rail and defense make the story believable. However, for more cautious investors, the danger for dilution and execution risks are just too big to ignore right now. The smart play here may be to watch and wait for proof. The upcoming financial reports will be the first major tests. They will tell us if the company is successfully integrating its new parts and if revenues are truly on track to hit that ambitious target. Is this acquisition-fueled growth a brilliant strategy to build a dominant new player in defense tech? Or is it a recipe for a speculator implosion? The next few quarters will tell the tale. Let me know what you think in the comments below.